Money, Power, and Monetary Regimes by Pavlina Tcherneva. Hierarchy of Money. The focus so far has been on state-issued liabilities and state-administered units of account. But it is important to note that, since money is a debt IOU, anyone can issue IOUs. Minsky, 1986. The problem, as Minsky argued, is to get them accepted, and indeed in modern capitalist economies, private agents finance their activities with position-making instruments, privately issued liabilities, which have varied degrees of acceptability. Banks create bank money at the stroke of a pen via the process of lending. As the endogenous approach to money stresses, loans create deposits, which in the aggregate create purchasing power from private credit. In modern financial systems, central banks stand behind the liabilities of the banking sector to maintain a sound payment system and accept bank liabilities for payment of taxes, thereby making them as equally acceptable as state-issued liabilities. The chartalist approach stresses that the multitude of private sector liabilities can be ranked in a hierarchical fashion, whereby the most acceptable and liquid forms of debt sit atop the money pyramid. Bell, 2001. Figure 1. The hierarchy of money. Government liabilities at the top, bank liabilities in the middle, private sector liabilities on the bottom. The most important feature of this pyramid is that every economic unit, except the government, has to deliver a third party's IOU that sits somewhere higher in the pyramid to settle its debt obligations. Firms and households settle their debts by delivering checks, bank liabilities or notes and coins, central bank or treasury liabilities. Banks settle debts among each other by delivering reserves, central bank liabilities. The government is the only economic unit that settles its own debts by issuing more of its own liabilities. The state issues several types of liabilities. Some are issued by its monetary agent, notes and reserves, and others are issued by its fiscal agency, coins, treasury checks, and treasury securities. The issue of each of these liabilities is the exclusive sovereign monopoly power of the state. The payment of one liability, treasury check or treasury security, for example, takes place when the state delivers another one of its liabilities, reserves. While private contracts and debts clear in the state-issued unit of account, reserves, it is private finance that drives the capital development of modern market economies. It is also private finance that causes frequent financial and economic instability. Minsky, 1986. But the final responsibility for the stability of the financial system rests with the state. A capitalist system is a financial system, argued Minsky, 1986. It is an evolving and innovating system, continually looking for new profitable opportunities by creating markets for new private sector liabilities. Banks create new position-making instruments, either for the purpose of financing the capital development of the economy or for financing finance. The process of funding the acquisition of real or financial assets adds another dimension of instability to the capitalist system, and the process of financial innovation is often accompanied by creative accounting practices and fraud. From this vantage point, as legal theories of finance illustrate, financial markets are essentially hybrid systems, neither private nor public, neither purely of the state nor purely of the market. However, the law and its enforcement rest with the state, as private and public debt commitments are enshrined in law, legal contracts. Pistor, 2013, argues that in the throes of a financial crisis, when the full enforcement of legal commitments would result in the self-destruction of the financial system, the full force of the law is suspended to ensure the survival of the financial system and prevailing financial relations. Where law is elastic, she states, power becomes salient. When Knapp proclaimed that money is a creature of law, 1973 and 1924, he did not say that money is a creature of legal tender law, as in Schumpeter 1954. Indeed, Knapp explicitly rejected such an interpretation. Money is a creature of law because the state is the adjudicator and enforcer of non-reciprocal obligations and other private sector contracts.